Good morning. You're watching the market right here on 80 now. We're kickstarting a brand new week. Morning, guys, and it seems like officially the winter is completely over in Mumbai, right? It's getting warmer and warmer by the day.
Delhi's become chilly again.
Oh, it has?
Yeah, I
had
just
no
checked in the
idea.
morning. It just appeared that even for Delhi, when I was there for the FM interview, it appeared to me that in Delhi also the summer in the sense had gone. But again, volatility in weather.
But no complaints over here. I'm quite happy.
Really?
Yeah.
Okay. I was loving the Mumbai winter
slight
for as
nip in
long
the
as it lasted. But is the winter over for markets as well? Have the clouds lifted?
No, Aisha, I don't think. You look at the Nifty, I don't think you were in the winter at all. You had few cloudy days, if I have to speak in the weather terminology, but you never had very dark clouds. You had a little bit of fog on the windscreen, so to speak. But from a market standpoint, if you look at the market from the prism of Nifty, I guess markets have done very well for themselves. Look at what has been thrown at the market. The sell-off in Adani group of stocks, that fiasco, budget volatility. Globally also, inflation is coming back, and we've thankfully come on the right side of the Fed event. So despite that, if Nifty has been flat to range bound at least this year, I guess that's a victory for the bulls. But last 2 weeks have been very hectic for the market. Budget adjustment, earnings, the adjustment in Adani group of stocks. But now next 2 weeks, we don't have a very big planned calendar event of news, which means next couple of days the market move, if nothing new happens, at least if there is no new event which markets will have to negotiate with. So if everything goes as per planned, the next couple of trading sessions, they would be a function of how essentially technicals would move and what will happen to phase. So from an extremely news heavy patch or phase, we are going to be moving to a phase where rather than getting a trigger from an event, I guess markets will have to pretty much restrict themselves to technicals, flows, the dollar index, and pretty much the basics which drive technicals in the short term.
Yeah, absolutely. As we step into this brand new trading week, we're clearly moving past the budget, most of the earnings as well, and FII flows are only improving by the day. In fact, on Friday, you had a net buy figure of 1,458 crore rupees. The move in Reliance, the move in HDFC Bank, clearly are now going to guide the Nifty going forward. And while, of course, we remain range bound, the only good thing is that the range has moved a little higher. So 17,600 to 17,900 thereabouts is where we're currently at. And the rally definitely in the mid-cap universe, that has now widened. We've risen about almost 2% in the week gone by. But clearly, Avan, looking at the F&O price action, what's that data indicating?
Well, it's clear focus then in terms of, the Nifty and the Nifty Bank seeing mild shorts and some short covering. But the other big data point, Aisha, is actually what's happening in new age tech. And that's really the buzzword for the week gone by, I think. And perhaps, Nikunj, investors would have found it, a prudent stock strategy to have held it out, because now this commentary of path to profitability is clearly boding well for a lot of these companies.
No, look, there's a big departure in the market narrative. Markets have realized that the fintech or the consumer tech or the new internet companies, the promoters now very, very conscious of the importance of profits. You can grow, but if you're growing by burning capital or cash, that is something which markets are not applauding. So Paytm in a sense really changed the market mood, because Paytm in a sense has been really at the center of this entire center of the sell-off which happened in some of the fintech stocks last year and early this year. So post Paytm, we've got numbers from Zomato, where again, if you look at the numbers and if you look at the aggregate picture, including adjustment, numbers were in line with estimates. I think there is a bit of a surprise which has come from PB Fintech, and for delivery, I think it is work in progress as the operating leverage is still working. But my limited point is that there are two factors at play. A, change of heart and change of strategy by some of the fintech and consumer tech companies, which is very crucial and it is imperative. But more importantly, globally also interest rates are peaking out. And typically when interest rates peak out, some of these growth stocks in a sense will stop falling. So there are two factors which are at play: change in business strategy and the way the companies will now uh, grow, or the way they would now boost their profitability versus what is happening to the global landscape. I think we are in that phase of the market where the worst of the fall is behind us, and now this space will get selective. In Paytm, I guess the result adjustment is over. Zomato result adjustment is over. I don't expect delivery to do exceptionally well based on these numbers, but I guess somewhere policy fintech, based on the numbers and based on the core growth, I think could be a one where you may see mild outperformance going forward.
Oh yeah, given that they've posted a strong Q3 and their premium, of course, has jumped. Let's tell you about the other earnings as well, which came by over the weekend. And you had Lupin, wherein they've delayed the launch of one particular key drug. There's ABB India as well, wherein both the PAT as well as margins now at a decadal high. So Cap Goods, of course, has been a very, very strong story that the street has been tracking. And then, of course, there's Balkrishna Industries as well. Week average selling price is what they've clocked all throughout the third quarter. So these are a couple of key earnings that the market is going to be penciling in. And the news flow on the Adani group of names clearly continues. Ports and Transmission and Adani Green are all going to be in focus. There's been an additional promoter share pledge to SBI Cap trustees, and the pledge comes in as part of the $300 million LOC for Carmichael project. Moody's, in the meantime, has cut the outlook on 4 of their entities to negative from the earlier stable, which clearly reflects potential reduction in funding access. So that's really been Moody's takeaway. This is the tricky part in the market and continues to be so, I guess.
Asha, there are two things to it. One, the news flow. I guess the news flow is going to be, I don't think we've got crystal clarity on which way things now would move for Adani group of companies. Of course, arithmetically, it's very simple that if the capital, the FPO cash is not going to be there, the business has to slow down. All Adani group of companies now will have to slow down, because if you don't have additional equity or additional capital, you will have to slow down the growth. That is something which I think markets are aware of. Where there is a bit of a yes, no, and I don't know, is that how incrementally some of the companies individually would be looking at repaying their their debt obligation, and especially the interest obligation at a time when business will start slowing down. So that's the second part. That what would be the collateral damage to Adani group of companies on an aggregate picture, at which are the businesses which will slow down and which are the businesses which in a sense will hit the hardest. I would imagine that the new growth businesses are the ones where the slowdown would be the highest, which is airport, green hydrogen, largely infrastructure based. Then the second part is the secondary market, which is the underlying stock price. I guess worst of the stock fall is clearly behind us. Stock performance now will be a function of news flow rather than technical and sentiment. What we saw, let's say, in and around budget, the sell-off in Adani group of stocks was a function of compulsion, technicals and flows. I guess that storm or the barrage of selling in Adani group of stocks, that clearly seems to be behind us. But I don't think we are for a V-shaped recovery for some of these stocks. Look, these stocks were trading at lofty valuations. There was a compulsion which is at play, and growth will have to get readjusted. And when growth will get readjusted, markets will start pricing these stocks very differently. I guess we are reaching there where the markets will now start pricing these stocks very differently. Since markets will start pricing these stocks very differently, it is safe to imagine that a V-shaped rally in some of these stocks is unlikely to happen. But like the fall or the excruciating fall, what we saw in the secondary market in some of these stocks, function of technical and compulsion, that also is behind us. Net, I think these stocks will now start making base in the next couple of days.
Okay, let's just quickly bring up the SGX Nifty. That's indicating a bit of a tempered start. And by the way, a lot of earnings this week as well. You've got Grasim, you've got Apollo Hospitals, Bharat Forge, and then Nykaa. I think this is the last of the new age fintech companies to report its numbers. So an intriguing and interesting week up ahead for us. But Safir Anand, he continues to remain very bullish in logistics, Aman.
Absolutely. We interacted with him just last week, and he's saying this is a great space to remain invested in. He shared some names as well. He said that Blue Dart, Aegis Logistics, and many more look very attractive. Listen in.
I do believe that in the logistics sector, companies like Blue Dart that are expanding rapidly, they are buying planes. Both Blue Dart and their parent DHL are talking about a very large capex. They're a technology leader, they're a market leader. the market all of a sudden reacts to a slowdown that happens because ATF fuels, and then one day Amazon decides to announce 2 planes, so the market reacts. The same day DHL announced 3 planes, or the next day nobody cares. So you have to look at opportunities. You have to look at the cash that these businesses generate, the kind of dividends that they offer, their parentage, their lineage. Similarly, TCI Express, which a stock that is corrected in the same sector, look at what the company has done. Of course, the stock is still more than double from the level at which I entered, but look at what the company is doing. They're right now going through a buyback. So the logistics sector is telling you, and even companies that I don't own there, like a Mahindra Logistic, or another logistic company that I do own, Aegis Logistic, the commentary seem to suggest that there is a lot of work that is happening there. Even smaller players are registering. So I will be a believer there, at least on the long term, and I do believe that the sector is a sunrise sector in India.
Murthy joins us now, and Naresh is also ready. Let's connect with both of them. Naresh, CA, good morning. Thank you for joining us. Naresh, we've had a patch of extraordinary volatility in individual stocks, 2 weeks of hectic and heavy news flow. Next 2 weeks, we don't have a planned calendar event. We don't have any big thing happening again in terms of earnings. Do you think now technicals and liquidity, those internal factors will take over?
So even through the news, what we've seen is the market has been resilient. So for now, we would be waiting for price action to confirm a trend. As of now, we are still stuck in the trend, that range of 17,600 on the lower end, 18,000 on the upper end. The only thing which popped up on last week is the fact that the BSE small cap and the Nifty small cap index actually made a 5-day high, and there was a good change in positive breadth. So overall, the bias remains positive, but we wait for the indices to actually give that breakout move to start getting more aggressive. Till then, there are a lot of stock-specific opportunities which continue to remain there.
Specific opportunities. Is that your view as well? The index has not gone anywhere, but it's actually individual stocks that one should focus on.
Good morning, Aisha. Definitely, I do agree with that view of Naresh. And in fact, if I have to just give you those levels on Nifty futures is now stuck in that tight range of 250 points, which is 17,750 on the downside and 18,000 on the upside. So I will definitely wait out for this range to break out. And I feel this time the break should happen on the upside. Market has been very resilient for 2-3 days, and price action has been stronger on the positive side. So keeping a stop loss of around 17,750, I will make an entry at current level or any dips I get on Nifty future, looking at initially that 18,000 level, and once we cross 18,000, a bigger move will come on the upside. Similarly, if I have to see Bank Nifty has strong support at 41,300. So if we hold this support of 41,300 on Bank Nifty future, we will be looking for targets closer to 42,000. And once you make that close above 42,000, then I will say this down move is fully digested and taken care, and we can see higher levels. So I want 18,000 to break on the Nifty future and 42,000 on Bank Nifty future. I will utilize dips to buy, and I remain now positive on market.
All right, that's a pretty much consensus view coming in from our chartists remaining positive on the market. So let's find out then, Naresh, you're positive right now. The way we wrapped up on Friday's trading session was absolutely flat, but around the 17,850 mark. What are your trades this Monday morning?
So first I'll be going with a large cap, which is a risk reward bet, which is Reliance Industries. Now the stock is trying to make a base around 2250, 2300. Now this is a very important level. Back in September 2020, when the whole fundraise got over, the stock topped out at 2300. Then over the next 1 year, that was a resistance. Then we broke out above those levels. It went to 2750, which was tested 3 times. And over the last 1 year, during windfall tax, during Russia-Ukraine, this was the price point roughly which the stock continued to hold on. So out there, if this is a stock which holds on to 2300, we could expect a move towards 2400, 2450 in the near term. And once we can cross 2450, you have a leader in the Nifty pack that would confirm a possible breakout on Nifty. So this becomes a very interesting trade. Stop loss at 2300 and a target price of 2400, 2450 in the short term. Second is a buy on Indraprasth Gas Limited. We are seeing a breakout in a lot of these gas names. So we covered my Mahanagar Gas. Now the next one is IGL. The whole pack as such has underperformed over the last 2.5 years. And now finally after consolidating for the last 3-4 months is on verge of a breakout. Multiple attempts made around 445 to 450 for IGL. On Friday also it came very close to it. If it breaks above 450, you could expect a quick move towards 500, 550 in the short term. A stop loss to be kept at 425.
Right. CA, what stocks are you recommending to our viewers?
For me, definitely sector-wise, metals looks very good, and also for me, autos will be the sector for the year. I'm picking Tata Motors. Tata Motors post that result where it made that big gap up move has sustained and seen accumulation pattern for me on charts. So if you see Tata Motor last 4 trading session, 430 has been held very strongly, and it has repeatedly bounced from those levels. Open interest addition is also seen in futures on the positive side. So for me, Tata Motor is a positional buy available in F&O. Look at initial targets of 480 with a stop loss of 430 offers a very good risk reward even at current market price for me to go in and buy. Second stock I would recommend is Federal Bank. Again, this is another stock which has clearly consolidated above levels of 130. At current market price offers a very good risk reward trade for me to buy. I am looking at initial targets of 142 and eventually 160 on Federal Bank. I am keeping a stop loss of 128 and go long on Federal Bank. Looks very attractive on chart.
Very much for those top recommendations. Meantime, there's lots of other news flow that we're tracking. The Prime Minister Narendra Modi will be inaugurating the 14th edition of Aero India today in Bengaluru. The event is scheduled to be held for 5 days, and participants from 809 companies are going to take part in showcasing the country's aerospace and defense capabilities. And not just that, on Sunday, the Prime Minister Narendra Modi inaugurated the Sohna Dausa stretch, which is part of the Delhi-Mumbai Expressway. This is the 246-kilometer stretch, and it's really going to benefit people who travel from Delhi to Jaipur. They now have a quick, alternate, shorter route where the travel time will be reduced by over an hour, so it could take approximately 3 hours to reach.
Market, the SGX Nifty indicating once again a very listless start, but it's going to be really all about earnings once again. And let's address one set. We have the MD at Kim's Hospital joining in on the show right now, Dr. B. Bhaskar Rao on the show. Dr. Rao, great to have you on the show. Tell us, what is the growth that is expected in existing units of AP and Telangana? And can we see high single-digit margins while they have expanded in both acquired units? That's Sunshine and Nagpur. Wanted to understand if you see a further headroom for room expansion.
Yes, as far as the Andhra and Telangana matured units are continuously growing around a single digit as we expected. There is a legacy acquired units like 4 units in thing. They are also growing in a double digit. And the next 1 or 2 years, 24 and 25 financial years, we expect a lot of growth from Sunshine and Nagpur. From there again, we have been planned for the 25 and 26 also. Nasik and Bangalore and other things will kick in. I think as we expected, there is a constant growth as we anticipated about a couple of years back. We are on track.
So do you think near-term margins can see an issue, or do you sense that they can be likely impacted by addition or replacement of clinical talent at these acquired units?
No, the acquired units we expect at least it will take 3 to 4 quarters. One, to change the culture, and then the importance of the existing consultants about their pricing, and as well as they have the required quality things, and we need to acquire those people. When we get a new people, they will take at least another 1 or 2 quarters to understand the entire ecosystem of the hospital and the patient mindset and our culture and all those things. So usually any acquired units will take about, we are very confident that acquired units also do well as we have been, unless we don't do the homework before we acquire. whether we are going to maintain the margins that what we have been doing. As we expected, the implemented the culture, the pricing of the patients, and as well as the consumables cost and operational efficiency. When we see there is a headroom in that, we can able to show some growth. Definitely, we will acquire those type of things. So all these years, whatever we acquired, and we never failed, and we are showing the sustainable growth on that.
All right, Mr. Rao, hi there. Good morning. I just wanted to also understand, the company is continuing that capex phase of theirs as well, and there has been, acquisition of minority stake in quite a number of subsidiaries. Do you think it can all be managed and funded primarily via internal accruals? And can you walk us through how you expect these subsidiaries to perform?
So the plan initially was to, whenever there is a people who wants some money, then we want to acquire those stakes, and and that's what we are continuously doing. In nearly 2% we acquired in Srikakulam, and then in 4% in Kondapur, and nearly 6% in the Sunshine. So these are all the things on an ongoing process, and we have sufficient funds as far as the internal accruals, plus without stressing the balance sheet. We are very, very comfortable, and all these last couple of years we raised some funds during the IPO time, and also the internal accruals were sustaining. That's why we are almost zero debt. Now, because the opportunities are coming, we will maintain the same discipline of the financial deployment and show the growth rather than burden and then stress the company on the growth. So we are very, very confident, both internal accruals, a little bit of 1:1 nearly of the debt equity, debt EBITDA. With that, our expansion plans are being online.
Okay, fair enough. So you're going to further up your stake in these units. I just want to understand that, and also walk us through the updates, with respect to the Vizag Gastro unit, the projects that have been undertaken in Nashik as well as Bangalore, what the updates are in terms of when they will be operational.
See, the gastro unit will be maybe by April, May. It will be done. It's already on the waiting for the compliances from the government. The second important thing, as we planned, the Sunshine is going to shift maybe 1 or 2 months delayed because of the issues of the starting and then the manpower and the construction team. That is also online. And as we planned before, we have a financial, both the gastro units and as well as the Sunshine unit, and then the Nashik and Nagpur. These are all well funded, even including the Bangalore. So now we are looking for an acquisition mode to sustain our growth over a period of next 5 years. Whenever there is a great opportunity that comes either in the form of greenfield, semi-brownfield, or an acquisition, running hospitals, we are on the job. For that also we have a headroom to borrow that's why we took the enabling things from the board and our stakeholders to raise 300 crores of EBITDA. Whenever there is an expansion comes, we should not be shortage of money and get delayed the project acquisition is concerned. All are on the same page.
Right. Dr. Grau, great to have you today on ET Now. Thank you so much for taking the time out.
Thank you. Thank you very much.
Okay, let's move on and let's discuss all the stocks in news this Monday morning. And Kotak Mahindra Bank is set to acquire microfinance lender Sonata Finance for a sum total of 537 crore rupees. What's the rationale behind this acquisition? What does it bring on the table? Harsh joins in to tell us more about that. Harsh?
Well, yes, for context, Kotak Mahindra Bank has been speaking quite a bit about how they want to do more of unsecured. They were also one of the leaders when we're looking at the takeover of Citi's retail assets in India, and this could be seen as a step in that direction. They want to grow their the loan share of unsecured from 7.5% to around 15%, and this is one of the steps that they've taken with regard to that. Now, with regard to the deal itself, they've taken over Sonata Finance at 1.7 times price to book, which is of course value accretive for Kotak Mahindra Bank. Kotak Mahindra Bank, mind you, trades at around 3.4 times price to book, so hugely value accretive in comparison. But but the quantum of the deal is quite small. It's around a 17 to 1800 crore book, which they're taking over on a base of almost 3 lakh crore. That's insignificant where Kotak is concerned. But with regard to branches and the manner of lending of unsecured that Sonata Finance brings to the table, it brings in around 450 to 500 branches to unsecured, within Kotak, and that literally doubles up the number of branches in terms of unsecured that Kotak does. What it also does is it adds employees and it adds 3 key states. It adds Uttar Pradesh, Madhya Pradesh and Bihar to Kotak's book. That's a good foothold that Kotak gets into some of those states. So a couple of those levers that Kotak has in terms of past precedents. They've taken over BSS Microfinance in FY17 and they've grown the book 10x in the last 6 years. So if that is any base to go by, it's definitely a huge positive if at all Kotak is able to do that with the current acquisition.
Very much for giving us all those details on the big acquisition of Kotak Mahindra. Moving right on then, ABB in the spotlight as ABB India actually reported a stellar third quarter numbers. The profits and margins hit a decadal high and the top line growth as well was up about 19%. That was the stock on Friday's trading session, but today you are likely to see a further follow through perhaps. Let's hear out what the management had to say on the road ahead and what the drivers are going to be for the company.
I think the last quarter, which is, has been quite good in terms of orders as well as revenues and the profitability. But not only the last quarter, but the last whole year. If you see our growth numbers, they are quite good. We have grown our revenues by 24%. Our fresh orders are grown by 31%. And of course, it's also reflecting in our profitability. And we are also entering 2023 with good order backlog.
At the quarter, EBITDA grew by 97%, sales grew by 15%, which means margins expanded quite significantly. What do you think happened? You took price hikes which came in this quarter and lower soft commodities did help the numbers?
Well, we have been experiencing on the supply side expansion due to expansion of the cost based on the inflation numbers we have. We are able to participate together with our customers on that increased cost pressure, and customers have been quite supportive. That's only that, but that neutralizes only the cost. I think what is playing well for us is not what we did in last quarter or last year. I think it's the portfolio, how we had developed in last 3 to 4 years, and how it is positioned in multiple market segments. And given the state of economy, I think many of the market segments are expanding. We have expanded in the new geographies. So it's an overall effect how the volume is passing through our books and our capacity utilized.
Okay, that's the word coming in from the ABB management with the margins at decadal highs and of course cap goods really the darling of the markets. Let's see how the entire pack moves today. But looking at the crude prices, Russia has said that it is going to cut its production by 5% of its total output, and GRMs of course are falling from its recent peak of January 25. So what is the impact then that it would have on Indian OMCs? Let me take it across to Samit to understand exactly that. Samit?
Well, if you see Brent crude from its recent low of around $79 per barrel on Feb 6 has suddenly moved up nearly 9% as now trading around the $86 per barrel mark. Now, a recent upsurge is on the back of the fact that Russia has said that they will be cutting the production by around 5 lakh barrels per day, which is nearly 5% of the total output, and this is because the Western countries have banned the Russian oil. Now, how does this impact the Indian refiners or the oil marketing companies? Firstly, because Indian refiners have bought nearly 30% of the crude import from Russia in January 2023. Now, from 22% that we had seen in November, the crude imports from Russia has now increased to around 30%, while the other major players from whom India has been importing crude are Iraq, Saudi Arabia, UAE, US also. Now, if you see the rising import import from Russia is largely in the back of the fact that Russian crudes are available at a very high discount, and nearly a 10% of Russian crude in the overall basket lives on refiners' gross refining margin by around $1.6 per barrel. Now, major oil refiners in India were also eyeing for long-term contracts, given that discounts are pretty high on Russian crude. But given the fact that now the crude production will be lower from Russia's side, and if there's a downfall in the imports from Russia, then this could hurt the gross refining margins of oil refiners. This, coupled with the fact that Singapore gross refining margins are also on a declining trend from around $14 per barrel that we had seen in January 25th. It has come down to now just $6 per barrel, which is a drop of nearly 58% in just a matter of days. Now, this is on the back of declining product spreads and because of the rise in crude oil prices. Now, generally, a $1 per barrel drop in gross refining margin impacts MRPL's revenue by around 700 crore rupees, and this is largely follows through to the bottom line. For oil marketing companies like IOCL, BPCL and HPCL, a $1 per barrel drop in GRM impacts their earnings by around 14 to 16%, while for Reliance Industries, a $1 per barrel drop in GRMs impacts their consolidated profits by around 4 to 5%. So do keep an eye out for the major oil refiners in India.
All going to be impacted. Somit, thanks very much for giving us those details. Let's shift gears. Stocks on the editor's radar then, and let's pick out then two stocks that we're highlighting in today's trading session. We start off with Lupin, and then of course we'll be discussing PB Fintech. So let's begin with Lupin, as the company has revised the target action date for Spriva approval. Brokerages as well have hailed this as quite a positive and are revising the EPS estimates. What are the implications?
Look, Lupin has been in a downturn. If you frankly ask me this, which is one large cap pharma stock which has truly disappointed. Even results were disappointed for the quarter gone by, before that, and even before that. So Lupin has been in a downtrend. The Suprava release, in a sense, was supposed to be a big release or a big drug for Lupin, considering that we've seen that typically when you come up with a drug release, and if it's a big drug release, it could really change the near-term earnings for Lupin, which desperately needs their operating margins now to go higher. This drug is something which markets had factored in their FY24 first half estimates. The drug has been delayed, which means estimates have to be pushed back. For a business which in a sense is struggling with its core business and they've lost their margins, for Lupin the margins at one point in time were 20% plus. Now they've gone to single digit, and with the delay of this drug, for a stock where you know that there is a bit of a challenge, and if there is going to be a delay, which means the estimates have to be pushed back. This is bad news for Lupin. For those who bought Lupin with the assumption that this wonder drug in a sense would be able to normalize their profits in the coming quarters, I guess they will be pushed back. And the stock in the near to medium term now will wait for the launch. You know, the problem with launches, Avan, is that once they get delayed, you don't know when they're coming next. So that in a sense now becomes this big overhang for Lupin. What markets expected and anticipated now is going to get just delayed and stretched.
Yeah, and no wonder then that brokerages across the board as well have got an underperform and a reduced rating. Okay, while this is bad news, it's nothing but good news when it comes to PB Fintech. On the path to profitability, much like some of its other peers, the company has reduced its losses significantly. The credit business is breaking even, and the commentary is great.
Yeah, so path to profitability seems to be this new fashionable term which every fintech and consumer tech promoter now seems to be endorsing. So there are two ways to it. Whatever you're indicating, is there merit in that guidance? Well, for PB Fintech, I would say that there is reason to believe, and considering what they've delivered in last 2 quarters, the path to profitability is well designed. Second, the core business, which is where I was waiting for these numbers to, for the quarterly numbers, the core business, which is the new insurance growth, number of renewable premiums, I think that's moving in the right direction. And this is one company which is not going to be affected because of that budget overhang, which came for the entire insurance sector. Also, incrementally, you know, it's a space where convenience really matters. Rather than going to the traditional agent who came to your house to sell you a policy, now you go online and you pretty much, you know, make your decision making. So it's got a very unique moat around itself in terms of the kind of product offering they have. The cash is decent in the book. It has underperformed. The challenge for PB Fintech is the anchor supply IP overhang. So for Paytm, it is getting lifted, but for Policy Bazaar, we know that the overhang is not over. So that's a bit of a technical, technical factor there. But I like the numbers. I would say Morgan Stanley, I think I would endorse the Morgan Stanley report where they think that the estimates are conservative and the company can actually reach the path to profitability way ahead of what they've actually guided.
Okay, so that's the word coming in, Aisha, on PB Fintech as well as Lupin.
Oh yeah, those two stocks in focus as our multiple earnings. So let's address another set. We have N. Kamakodi, the MD and CEO at City Union Bank, joining in on the show right now. Mr. Kamakodi, morning. Great to have you on ET now. For context, there was a divergence, as I see from your earnings, in the NPAs pointed out by the RBI. How much of the divergence has already been provided for, and will the balance then be provided in this fiscal itself?
Good morning. Actually speaking, the total divergence mark was 259 crores, out of which a significant portion of them were recognized as NPA in the first half itself. And the incremental provision that was suggested was 40 crore. And in this quarter, we have taken all provisioning that are needed based on the divergence already.
Okay. And with regard to the process of improvements to ensure the same doesn't reflect in FY23, have you been able to tighten the processes? How comfortable are you that there will be no divergences going forward?
See, if you had a chance to look into our past track record, about 2016-17, about 6-7 years back, we had one divergence which was above threshold size and which had to be, reported and published based on the RBI and SEBI guideline. After that, that has come about 5-6 years later, that has come at this point of time. And we were basically as I had been telling the investors in the con call, these are all not a simple 90-day overdue, and these things cannot be mechanized, and a lot of subjective elements are also there, particularly on that. And we have improved our system and put in best the system to ensure that it will not happen in the future.
I'll throw two numbers, sir. Your loan growth was up 12%. Now, on your base, isn't that less? Because even large banks are growing at 20%. Why are you growing at 12%?
See, we were expecting, we should be closing the year with about 15 to 18% and all. And basically, we had been right from the beginning mentioned that, we in fact took our legs off the growth pedal just before the pre-COVID. And in fact, we thought that we should accelerate the growth rate from the third and fourth quarter onward. We were expecting the investment cycle to start from the by December and all. Looks like things are getting slowly delayed. Also, the overall systemic deposit growth is also moderate. So taking into all these things into account, we go slow and steady, and that's why we have been able to consistently maintain our consistency in terms of profitability, efficiency ratios, and things like that. So we will do things we are not comfortable in increasing the growth rate beyond the maybe we thought 15 to 18 should be achievable, maybe slightly a tad less than that. But that conservatism alone has helped us over a period of time, and we want to maintain that, and we don't want to just accelerate the growth just because some of our peers are doing that. We will do things at our own pace.
All right, really appreciate your time. So glad you could join us. City Union Bank, I mean, if you look at the track record of this bank, they've been very consistent, very conservative in terms of the NPA. But loan growth of 12% for a bank of that size, that's not impressive. Large banks have given, even SBI on that large base, which is India's biggest bank, has given a mid-teen growth rate. I think it was 16.5%. So for 12% loan growth for City Union Bank, one would say that are they consciously slowing down? And if they're consciously slowing down, then on a relative basis, they will lose.